Picture this, you're retired. You've got maybe $2 million saved up, which sounds like a lot of money. You're now living off mainly Social Security, but also drawing money out every month out of your retirement accounts or your brokerage accounts or your joint accounts, whatever the case may be. Cash is coming out somewhere, right? Things are going well. Market's going higher. Investments are doing well. But there's always that looming threat. Is the recession going to come? If it comes, how much am I going to lose? How do I protect my capital? How do I make sure that my money outlives me and I don't outlive it? These are honestly some of the main concerns I'm hearing from people who are already retired or people who are about to retire. So today, we're going to address at least 6 different ways that you see commonly investors are using to hedge against downturns in the market. And the last few takeaways I think are going to be absolutely crucial. So stay tuned to the end. Hi everyone, for those who don't know me, my name is Will Snodgrass. I'm the president of Mat25 Capital. We are a Texas-based Christian advisory firm, and really the goal today is to give at least some of the most common ways that we see our clients and others that are retired or about to be retired hedging against a possible downturn in the markets. Why is this important? Well, studies have shown, number one, people are a lot of times more concerned about the downside than they are the upside. They're more concerned about limiting losses than they are about maximizing gains. And this is really prudent, especially when you consider that if you're retired or you're about to retire, you're no longer in the wealth accumulation phase. In fact, you're now in the part of your life where you're going to start dissipating and dispersing investments or assets you've built up in order to maintain your lifestyle and eventually one day passing them on. Not to mention, a loss or a significant loss at that stage of life is a lot harder to recoup than if you were younger. If you were younger, you have time on your side, you still have a lot of working years ahead of you. If you're already retired, well, your working years are behind you. You have a finite amount of assets, but you have living expenses that are never going to stop just because of a market downturn. Not to mention, let's say, for example, you lose 20% of your investments in a given year. In order just to get back to break even, you're going to need to recoup and make at least 25% to get back to break even. You lose 50% of your investments, you're going to need a 100% return just to get back to where you were. One option we see people use is going super conservative, going all into cash, things like CDs, maybe treasuries, bonds. If you have a large amount of wealth, that may work for you. But for most people, part of the problem is, one, that's not really a good strategy, especially when it comes to keeping up with inflation. Historically, cash and other fixed income securities are great for producing income and for being a more conservative investment than stocks. They're a good diversifier, but they do poorly in the long term when it comes to keeping up with inflation. Not to mention, you have to always keep in mind taxes. A lot of those investments, unless they're municipal bonds, are going to be taxed. So even if you're, let's say, receiving 3-4%, whatever the case may be, you're going to be paying income taxes on the dividends. So you have to always keep those things in mind. Another strategy we see implemented sometimes that we don't recommend is timing the market. Why don't we recommend that? Well, studies have shown that historically people time the market incredibly badly. They tend to be more wrong than they're right. And the problem also is that when you're trying to time the market in terms of when to get out and when to get back in, you don't have to be right once, you actually have to be right 2 times. You have to be right when you get out and you have to be right when you get back in. It's hard enough being right once when it comes to timing the market, let alone twice. And sadly, the stats show very clearly that most normal investors who attempt this do so very poorly, and it oftentimes means they sacrifice a lot of performance. In fact, the studies have also shown that if you miss just a few of the best days of the market, which usually follow some of the worst days, your overall average performance goes right into the toilet. So I don't recommend trying to time the market. It's usually a fool's errand. Most people are going to suffer for it. Number 3, you might hear from people that call themselves advisors, are annuities. Annuities carry a lot of bad connotations, and you have to remember, an annuity is just a solution. It's just a product. It's not neither bad or good. Part of the problem that comes with these, one, are the people who are selling them, and 2, a lot of times there are strings attached that really aren't talked about up front, and that's why they usually carry with them such a bad connotation. It's just a tool. It can be used appropriately, but sadly, the truth of the matter is with annuities, one, they always come with strings attached. There's usually hefty penalties if they're withdrawn or liquidated in the first few years. And really, here's the biggest problem. The people selling them are always the ones who do well. The people buying them are not always the ones who are doing well. So while an annuity may or may not be an appropriate solution for some investors, for many, it may not be, or there may be other solutions out there that are better, that are more liquid, that don't carry the same risks or the same penalties involved. At the end of the day, it really comes down to, do you trust the person who's giving you the advice, or are they really just looking to make a sale, make a commission? That's why we always encourage people, seek out people that are CFPs, seek out people that are fiduciaries. They legally have to put your interests ahead of their own. If someone just says, well, I have your best interest at heart, that's all well and good, but they're not going to necessarily be held to the same high standard that a fiduciary and a CFP are. A fourth way, and this is a much better way to guard against the downside, is diversifying. There's a reason why people say don't put all your eggs in one basket. You don't want to have a bunch of investments or assets that are all correlated. I mean, you don't want them all to behave the same. So if one goes down, others go up. It's a great diversifier. It's a great way to guard against market volatility, because if you have, let's say, equity funds such as stocks and mutual funds, index funds, which track indexes like the S&P 500, or individual positions like Apple, Tesla, Amazon, whatever the case is. If you have assets that don't behave just like them and are not equities, then when those assets go down, the others will, in theory, go up. This is one great way to hedge against downturns in the market. And frankly, it's one of the main tactics that we deploy, and most prudent, good advisors deploy, to try and really mitigate downside risk for their clients. Another option, another layer to that, is hedging. And what do I mean by hedging? Well, it's when you start looking into, let's say, more non-traditional investments or non-traditional style of investing. This isn't necessarily for everyone, but if you look into things like, let's say, options, or there's new types of investments called buffer ETFs, or if you look into, let's say, real estate or mineral rights, or whatever the case may be, there are ways to invest into non-traditional or alternative investments that do allow you a way to really mitigate some of the downside risk, or going into asset classes that really have absolutely no correlation to the market whatsoever. Now, with any of these, number one, you got to do your homework. Number two, you have to understand what you're investing in and why. What's the purpose of it? What are the risks associated with it? What are the costs associated with it? And if you're not comfortable doing all that legwork on your own, then you really need to make sure that whoever you're working with, or whatever firm you're working with, they do all that work. They are the subject matter experts and can not only explain those things and do all the due diligence for you, but they also have your interests ahead of everyone else's. We go back to the importance of being a fiduciary. They can be trusted, they have a clean record, and there aren't inherent conflicts of interest. Again, these are options. Just make sure you know enough about them to either do it yourself or be with a group or a person who will do all that work for you, and you can trust their advice. Number 6, and I think this is probably one of the most simple ways to hedge against these kinds of things like market downturns and recessions, but separate your money into buckets. If you have the majority of your net worth all invested one style, right, or in one type of portfolio, that's really not the most prudent way to do it. What we advise clients to do is look at what are your short-term goals, typically anything from the next few months to 1 to 3 years, and that would be your short-term bucket. These are things that you're going to need money for, to either pay for bills, go on a trip, pay for presents, let's say for Christmas or Easter, or whatever the case may be. These are the types of things that really should not be invested in anything that can lose principal or is illiquid, because you need to have access to it. And over the period of that short amount of time, you need to be able to draw from it readily and quickly. A more medium term would be, let's say, maybe 2-3 years up to 5-6 years. These are things where you don't need the money right away. You want to earn some kind of rate of return, but you also don't necessarily expect this to be funds that you're using for the long duration. You don't want to be taking a lot of risk with it because of those reasons. So this is where you're looking for more conservative investments. They don't necessarily need to be completely liquid, but they also need to not be taking a huge amount of risk either, because the reality is you're going to need them in a short amount of time. The last bucket would really be the long term. This is really where you're going to find the retirement accounts, the pensions, if you will. You're going to be finding things that are geared for the duration of your life, or ultimately what you're going to be using to leave a legacy. This is where you can afford to perhaps take some more risk. Now, granted, if you're over a certain age, you may be drawing from these accounts, such as RMDs from IRAs, but the majority of the funds should be invested in such a way that they can provide for the lifestyle that you want to maintain. They achieve the long-term goals that you want to achieve in the amount of time you want to achieve them in. And if leaving a legacy behind to either children, grandchildren, a church, an organization, or whatever the case may be, is part of your plan, then they're ultimately geared for that as well. Here you can afford to take some more risk. You can weather a certain amount of storm, but you also still need to be guarding the downside, because the reality is a major downturn, if not properly managed well, could completely derail the plans you have in place. So always make sure, am I invested in such a way that lines up with the goal I'm trying to achieve in the amount of time I have to achieve it, and taking the amount of risk not only that I'm comfortable with, but is necessary to give me the greatest likelihood of success. The one thing I would tell people, and I'd say this quite a bit to those who are clients of ours, is don't go chasing after returns. If you do that, you are gambling. You will be taking on more risk than you should, and you risk really losing principal in a fashion that is just not appropriate. Thank you all for your time. If you have any questions or want to reach out to us, you can reach us at matt25capital.com. Remember, some of the big takeaways, if you take nothing else for this, is 1, make sure you have a plan in place before market volatility strikes. Those who have the plans in place already are the ones best prepared for the storm. You don't want to be making plans and trying to come up with a strategy once the volatility already has struck. And 2, it's not just about how much you make during the good years. It's about limiting your losses during the hard years. The saying I've used for many years is not about catching every shooting star. It's about sometimes avoiding the falling knives. Thank you all again, and have a blessed day.